guess Bill and I had been both active in this area since the early 70s. He came back from Harvard and set up a small fund which basically did seed and expansion capital, and that was a number of high net worth families. I joined an industrialist who was a Hungarian, and every Hungarian with a good business idea in Sydney was hitting on him to say, I've got this great idea, will you fund it? So I ended up joining him, and that was my first job out of uni, really riding shotgun on deals that he sort of authorised, and then gradually I became involved in seeding them as well. And we ended up doing seed, expansion and MBO. We did a couple of MBOs in the 70s as well. So by the mid-80s, Bill and I started talking about that there was probably enough evidence that you could do deals across that whole range of investments, and that we could get some institutions interested in getting the first institutionally funded private equity fund up in Australia. And so we started that in mid-87, and of course the stock market crash came sort of in October of that year, and we thought that was the end of that. But interestingly, the investors got it, that without a capital market available for companies wanting to expand and raise capital, a private equity fund would actually be better positioned post the crash than in the boom time ahead of the crash, when you could raise money easily on the stock market. So in fact it turned out to be a silver lining, and we got our first fund, a $30 million fund, away in 1987. And I remember to this day people querying us whether 30 million was far too much. Would you be able to invest it? It was really a couple of years before another fully institutionally funded, rather than the private net worth fund got going. And then it really sort of got going. I guess the momentum really built up in the 90s.
So it was a firm set up effectively around the sort of hypothesis that there was a gap in the market for mid-market buyout. So, historically in Australia, PE had been sort of these small pools of a generalist funds, so people would do everything from VC, growth capital, baby buyouts. There was sort of no sort of core investment focus. As long as it wasn't listed, then they'd do it. We said, look, there's this opportunity to actually focus on sort of acquiring companies 100% with enterprise values sort of north of $100 million. And so that was the proposition we put to the market. The market, while they kind of thought it was attractive, we were seeking $200 million, we ended up getting 101.3, of which that last sort of 20 odd was friends and family. So we weren't really capitalised, but what it did mean was we had to then pull a lot of other people in, like AMP, to club on these deals. And so actually what we found was we kind of formed a community of guys who are now focused on doing buyouts in that, at the time, obscenely high price range of more than $100 million. So kind of that first couple of years was as much about establishing the buyout market in Australia in a sort of more of a pure form.
The origins of our business were that we spent as a team 20 years in consulting. So this is working for third parties looking to add value. And our experience was extraordinarily encouraging. We saw total shareholder returns increase across the portfolio by 42% per annum. And so the question on our minds was always, could we do that in a different format to capture value in a different way and have a more successful line of sight, or more compelling line of sight on how to change businesses? Private equity is the obvious alternative. There were a number of enterprises that would now today be described as captive funds. So there were a few large institutions with funds that were investing in businesses, but there was nothing that was classic standalone leveraged buyout private equity. And so to establish that, we had to go in fact offshore to get the technology from the US, where we had to bring in the types of contracts and understandings that were already established in that market that were involved in the accounting firms and the legal firms over there, and bring that technology into Australia. And so it really literally was starting from ground zero.
the idea sort of germinated. We thought about it and then looked at the market regulatory environment, and there was a regulatory restriction, a pretty big one. That was majority ownership was prohibited by financial sponsors and board participation. And so while we started with the idea, it was 5 years from there to that regulatory change actually taking place before we could start the first fund. In the aftermath of the bubble, there was a lot of deregulation, financial reform, things that were happening, and this restriction on financial ownership, majority financial ownership, was on the docket to be changed. And when it did, so we had the plan and the idea, waiting for that to happen. When it did happen, we were sort of first guys out in the market to say, let's go do this. There was clearly a need because of the banking sector in Japan that had long been sort of providing basically free capital to all sorts of segments in the economy, was unable to continue to provide the same level of capital they had been because of the consolidation, the restructuring, the NPL problems that we had in Japan back at the time. The bank balance sheets were very weak, and there was consolidation happening in the banking sector, which meant bank capital was not as readily available as it had been. And so, yes, the people that fill that pinch are medium, small companies that are now looking for alternative sources of funding, and they're also faced with succession issues, which began emerging even back then as part of this. So an alternative sort of sponsor emerging was, welcome in some sense. And the needs in terms of demographic changes with founder owners and the changing in the banking sector availability sort of dovetailed into the start of the first fund.
We closed Tasman Building Products on the 6th of April 1998. There was 155 million Australian enterprise value, so that was the largest deal that had been done in Australia for more than a decade. And it was a very successful deal, so it's sort of about 4.5 times your money. And it really carried that fund and just presented so much momentum as to, well, look, here's the case study, it can actually be done. Now, if you provide us with more capital, we can continue to do these types of deals.
This company called iCreo was actually a subsidiary of Wyeth Corporation, a large multinational firm, and it was a baby formula, baby powdered milk Japan business. But that was one where sort of all the pieces of a leveraged buyout, even though it was a small company, we were able to get some debt, we were able to sort of have a proprietary discussion of carving out a subsidiary of a large corporation, affect some management change, and sort of all the elements of sort of leverage, financial sort of profit improvement, and multiple appreciation, sort of the three things that you build into private equity returns, all came about to really make that work. And it was also it was less than a 3-year period from investment to exit, so it all happened very nicely and very quickly, and it really was sort of the first true buyout, leveraged buyout model that we did.
And thinking back now to our first deal, which was Frucor, it was a purchase from the Apple and Pear Marketing Cooperative, I think in New Zealand at the time, and it was a beverage company. And so it was classic. It was the sort of deal that later on became very familiar to us, but it was our first deal. We're fortunate that it became a 10 times the money deal, a little under 10 times the money. But the journey took us through all the different stages of buying the business, enhancing the profits, trading portion of it included IPOs and other things along the way. So very complete journey and a very exciting journey for us.
I think the first time you'd say the proposition was established was probably the mid-2000s. So, between us raising our first 2 funds, PEP entered the market, Champ moved from being a growth capital fund to a buyout fund. They did the deal with Castle Harlan. Quadrant were moving more up into that space. So it wasn't until Catalyst was raising bigger funds. So it wasn't until sort of mid-2000s that, in a sort of Michael Porter sense, you had a cluster forming an industry. And of course that then creates its own ecosystem of advisors. So deal flow increases exponentially because there's a lot of people who can make money off us, charging fees and stuff. So they were out there looking deals for us. The law firms start having guys who are just covering the PE guys. So you go from kind of a sole trader almost to kind of a proper industry with some critical mass.
In the early 2000s, before you get to 2007, 2008, is just if you look at all the elements of Japan, second largest economy, now third, but at the time second largest economy in the world, the whole depth and spectrum of industries and sectors and numbers of enterprises, that at least at some level comparisons with the United States in terms of the potential for private equity investment. And nobody expected it to be at the same level in terms of GDP, adjusted investment. But even if it got to some fraction of that, in terms of M&A activity and private equity participation, there would be a substantial market and there should be large deals. I think that underlying premise still holds today, but there have been invariably various hurdles and bottlenecks and maybe other structural things that have not let that develop to that stage that I think the underlying potential points to. I think what we're seeing today is directionally towards the new normal. Certainly we've seen steady increase on the smaller end of the market in terms of founder succession deals and smaller carve-outs. That has continued the last 4 years, I think, steadily growing, and we continue to see very, very good pipeline activity and deals that we're doing there. And then on the larger end of the market, which has been very lumpy and sporadic in the past, a little bit more activity and consistency. It's hard to say that that's going to just continue at that level or continue to grow at that level forever, but certainly the latent supply of potential deals is there. And the question is private equity now really coming into its own in terms of being a viable sponsor for more and more of these deals?
We've been very fortunate in the experience we've had today. We've had a quite clearly segmented market. We've had very clear lanes of business for different players. And we've had very disciplined banking system, which has meant that we haven't seen extraordinary levels of leverage and the risks that come with that. And we've got quite a complex deal sourcing environment. So the combination of complex deal sourcing, disciplined banking, and quite a well represented but not over-represented market has meant that returns in this market have been very strong. As we look forward, we've seen, if anything, a reduction in competitive tension in the last couple of years, but we're also seeing a morphing of that. We're seeing some of the large Pan-Asian systems which have done deals in this country but have not had a good investment experience in aggregate at all, beginning to experiment with deals in the smaller enterprise value space. And so it'll be interesting to see how that develops. They're obviously great brands. So far, our experience has been they haven't impinged on the more difficult, more complex turnaround and value creation stories that tend to keep the local guys busy. So still we see a very strong segmentation.